Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's about 30 minutes to go now until the closing bell, and stocks are mixed. The Dow climbing higher while the tech-heavy NASDAQ reverses earlier gains. Let's welcome in here Inez Ferre joining us to break down the headlines. Inez, what are you seeing in the markets?
Josh, looking at the Dow, it's up more than 300 points right now and on pace, by the way, for its first record close above 48,000, if you can believe it. It would be the second record close in this week, yesterday being the first. And then the NASDAQ composite down 0.3%, as you were just mentioning, a mixed picture here. The S&P 500 relatively flat. If we look at the US dollar index, that is just an edge higher today, near 100. But looking under the hood and the sector action for equities, we are seeing healthcare, materials, financials that are leading the gains. Energy stocks and communication services are under pressure. And over on the Dow, United Healthcare up almost 4%. That's really driving the Dow higher. Goldman Sachs up 3%, also helping lift the Dow. Over on the NASDAQ 100, as we mentioned, some of the heavy, mega cap stocks a little bit under pressure with Alphabet and Amazon down. Also, Meta is under pressure as well. And you've got Microsoft that's up just 0.5%. But over on the semiconductor space, you saw NVIDIA that's down 0.3%. But look at AMD up more than 8% after its investor day yesterday. And then looking at the crypto action, we are seeing Bitcoin under pressure, down 1.2%, nearing the 101,000 level. We'll see if it punches below 100,000. It has not. It did last week just very briefly, but it has been just keeping it as support. And then also Ether down about 0.6%, around 3,400 per token. And over on the crypto-related stocks, those are under pressure, with Circle down more than 10%, despite a beat on the top and the bottom line for the company's latest quarter. Josh?
All right, Inez, thank you. Well, hopes grow over the record-long U.S. shutdown coming to an end soon. Let's get to Yahoo Finance's Washington correspondent, Ben Wershkul, with the details. Ben.
Yeah, Josh, so we do appear to be just hours away from the end of this shutdown, which is now 43 days long. The House of Representatives will soon commence, voting and debating this final deal, with President Trump saying he's ready to sign it basically as soon as they're done. House leaders are suggesting that timing here could be within hours, by the evening when this is all set up. And the White House even says that they might have some sort of signing ceremony later tonight if things go through quickly. But it could also stretch into late night, as Congress is wont to do. Till then, sort of a lot of floor speeches and last minute jostling. One of the final drama points here essentially is whether every lawmaker will be able to get back to Washington, fight through the shutdown, travel delays, in order to end the shutdown here. A quick reminder about what's in this deal. This funds some of the government programs for an entire fiscal year. It limits President Trump's ability to fire some federal workers, but it only delays a government shutdown for a few months' time. We could be right back here on January 30th with another shutdown deadline possible then. Until that time, a lot of the focus right now is on what the kind of economic damage is from this shutdown. Now, folks here in Washington, I think, are already turning to that. We're seeing that from airports, economic data. One measure from the Congressional Budget Office suggests that a 6-week shutdown, which is what this was, once everything is all done, will take about $11 billion out of the U.S. economy that otherwise would have been there, and that money will be gone permanently.
And Ben, while we have you, switching gears a bit here, we're hearing that President Trump, Ben, could be meeting with some Wall Street bigwigs for dinner. What's going on there?
Yeah, it's a busy night here in Washington. By a stroke of coincidence, this dinner is set for 7:30 p.m. in the State Dining Room of the White House, which is about almost exactly the same time this final shutdown vote is scheduled to be commencing. As you mentioned, this is a Wall Street dinner. Trump had a big group of tech CEOs recently, at Mark Zuckerberg sitting right to his right a few weeks back. This is expected to be the kind of Wall Street version of that. There's no formal guest list yet. The White House isn't releasing that, but there's a number of lists floating around out there of who's likely to be there. It's all the major names on Wall Street. Jamie Dimon, the heads of BlackRock and Blackstone, NASDAQ's Adena Friedman, Goldman Sachs, all these different heads will be there before the president. And it comes kind of at a notable moment for the president. who is kind of facing struggles on the economy right now. This affordability issue, which clearly isn't going away for the president. And of course, these leaders will also have plenty of time to have plenty of business of their own. We'll have an actual visual of this later tonight. The White House has confirmed. Cameras will be let in for a few minutes to kind of see who's sitting where and everything like that.
All right, we'll wait and watch and see. Ben, thank you.
Sure thing.
The Dow is eyeing another fresh record high close here as chances of an end to the record-long government seem more likely ahead of the House vote tonight. So do markets need the shutdown to end this week? For more on this, we have Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Megan, great to see you. Maybe we'll start right there, Megan. Government shutdown looks like we could be close to an end there. I'm curious, Megan, how you've been sort of navigating and thinking through this as a strategist. How much harder, Megan, has it actually made your job? You, like our central bankers, you're not getting all the government economic data you'd prefer.
Yeah, and what we're looking at is some of this private sector data that a lot of different people are able to get, but it's really not giving us that clear picture. And the one thing we can say is that markets don't really care too much about the government shutdown. And that's pretty evident on the rally that we've gotten in this repeated record high after record high. We've had a little bit of volatility, but really not much. The concern is here now when we do start getting more clarity around the economy, when we do start getting these regular releases, is that what's going to take some of this steam out of the rally?
Well, I thought it was interesting, Megan, what you were telling clients here. You say alarm bells are growing louder in the AI space. Which alarm bells, Megan?
Well, I think when we look at, we talked in that weekly that you're referencing, we did talk about the labor market as well. The labor market, what we're seeing from the AI, some of these businesses that are laying off, whether you look at it from the old tech and versus the new tech, we're seeing some job declines in those areas of the market. So that's ringing a little bit of an alarm bell there. Will we get more of that going forward, and will that impact the economy? And then don't forget that with the valuations just for the AI tech, the tech names being so elevated, is it starting to look bubblish here? We think it is. We think that this is a concern. All of this spending that's taking place, especially by these big mega cap tech giants, this is going to have to translate into earnings. And the market's allowed this to go on for some time, but eventually they're going to demand that earnings to come through.
Can I ask you, Megan, would a Fed cut address some of the labor market dynamics you're referring to there?
No, and I honestly don't really think the Fed needs to cut in December. I think the Fed needs to be more concerned on where we are with inflation. We haven't gotten the data, as we've mentioned. We did get that one CPI report, which was better, a little bit better than expected, but we're still not anywhere near the Fed's target. So I don't necessarily know that the Fed's going to do much to really help the labor market. The labor market is showing signs of weakening, but at the same time, we are just kind of, we're fixing some of the abnormalities we've had over the past few years, whether it was the surge in immigration, whether it was the overhiring after COVID. We're just now starting to get some of that back in equilibrium. See how that pans out, but don't forget about inflation. So I'm actually leaning more on the camp that the Fed can sit and wait and see. They don't necessarily have to go in December.
What do you make, Megan, I take your point about the labor market cooling, but GDP has been hanging in there. It's been resilient. What do you make of that dynamic? And do you see that continuing?
I think I think the fourth quarter is going to be softer. I think the first quarter maybe is still up in the air, but there are some positives in next year. Don't forget the tax bill that will come through. That'll be a benefit for consumers, and consumers really need it right now. Consumers have been extraordinarily resilient, almost unbelievably resilient when you look at some of the numbers. But there is a lot of the American consumers that are just felt this year after year compounding of inflation, and they're also now looking at weaker job prospects. This is eventually going to have consumers hit a wall. So we do think that you will have some slowdown here in the next couple quarters. We're not necessarily calling for a recession, but maybe a healthy slowdown that maybe we can get that inflation down towards the Fed's target.
And so if that's the call, if you saw a slowdown, Megan, what would that mean for earnings growth looking ahead?
Mm-hmm. Well, we think that the equity markets are just way too optimistic all around right now. Optimistic on earnings, optimistic that the Fed can orchestrate a perfect soft landing. Let's remember there's really only been one time in history that they've been able to do that. Every other time that they've been cutting rates has always coincided with a recession. So I think that Right now, equities, take a look at where your exposure is. We've been reducing some of the risk in our portfolios. We just think that the momentum in these valuations are getting way too stretched, and there is room for a pullback here.
Megan, great to see you. Thank you for your time today.
Thank you.
Well, for more on the outlook for the U.S. economy, tune in to Yahoo Finance's Invest event. That's tomorrow. And Lael Brainerd, former Federal Reserve Board Vice Chair, will weigh in on the path forward for rate cuts, the labor market, and a whole lot more. Plus, we have a whole slew of other heavy hitters on the docket, so don't miss Yahoo Finance Invest live all day tomorrow, November 13th, starting at 8 a.m. Eastern. Well, coming up, we bring you an options trading playbook. That's next on Market Domination. Volatility flare-ups revealing an increase in fragility of the market as uncertainty in the macro backdrop for the economy hangs overhead. We're looking at different ways to navigate it all in the Options Playbook, sponsored by Tasty Trade. And joining us here to discuss is All-Star Charts Chief Options Strategist Sean McLaughlin. Sean, it is good to see you. Maybe start bigger picture, Sean. You know, we're headed into year end here. I'm just curious how you want to be positioned. History would suggest, at least, the chances of a crash are behind us. So do you want to, as we head into year end, you want to lock in your gains here, Sean? Are you looking to generate income from existing positions? Just talk to me how you want to play the options market.
Well, I'll tell you, Josh, for the last couple of months, I've been of the opinion that the market was setting up for what could potentially be a face ripper rally into the end of the year. I thought maybe we had ignition in that 2 weeks ago when the S&P finally broke out, but then we retraced all the way back. And Bitcoin was falling off and not cooperating. And so the picture got a little muddied. You could blame it on a lot of things. You could say the government shutdown, perhaps. But I still think, and we still at All-Star Charts think that the market is positioned through rotation to continue surging higher into the end of the year. And if we do get a resolution in what's going into the House of Representatives tonight, that could be the spark. I mean, it could be anything, right? But I think investors want clarity. They want certainty. They want all this just indecision out of the way. Then I think stocks can go higher, and we're positioned for an end of the year rally, certainly.
How are you positioned, Sean?
Well, I'm long a lot of energy names currently, long a lot of metals and mining names, along some of the big caps like Cisco, Intel, Amazon. We could see a lot of capital flow into the big cap names, the Mag 7 names, because that's where the liquidity is. It could be a broad-based rally. It's been over the last, let's say, 3-4 weeks, it's been choppy because we had a big surge in some of these smaller cap names, these AI plays, data center plays, things like that had tremendous runs in October. In August, September, coming into October. Those have faded a little bit, but we're starting to see healthcare names really start to position well now. And we're starting to see money flow into the big caps. So I think it could be those names that lead the way. That's how I'm positioned. But I'm also, as an options trader, as someone who is long a lot of options premium here, particularly directed in the long direction, in the bullish direction, one way I'm hedging, Josh, is I'm selling call calendars or call credit spreads in SPX, which is the S&P 500 index options. And I'm doing that not because I'm bearish or betting on any kind of severe pullback, but if the market just chops around a little bit here, selling call credit spreads can help bring in income to portfolios that are exposed to long options premium here.
I want to talk about the government shutdown too, Sean. We got a vote coming up in the House, one step closer to ending this. One sector there that has been in focus for traders, investors have been the airlines. No surprise given the delays, the cancellations, but I'm curious what you're seeing there.
Well, when you look at charts like Delta and United and Southwest, they all look very similar. They all look like they're just kind of stuck on the tarmac waiting for clearance from the tower to go. Particularly Delta Airlines, that's the stock I've been keeping an eye on. It's been stuck in the range from like 55 to 62 for the last, let's call it 3 months. And I feel like it's just waiting for a catalyst, and maybe we'll get that catalyst when we get the resolution of this shutdown. I think Delta is the best name of the three. I like positioning here. I think you could do a low risk options play to get involved here. That gives you a couple different ways to make money. We have a chart on that if you'd like to show it.
We'll try to call that up. Meanwhile, Sean, before you go, I want to get you out on this because you mentioned Bitcoin. I want your thoughts there because you hit that all-time high of 126, Sean. But now you've basically been in this rough, 6-month trading range there, and I'm curious how you play it. Do you play it as a trading range?
It is definitely in a trading range here. Bitcoin has not been acting well. I find it curious and maybe not a coincidence at all that as more institutional money came into the market, you got the big banks playing. You got the ETFs like the IBIT and the ETHA for Ethereum. A lot of these new vehicles that have come into play for the casual, let's say, stock investor to get involved in cryptocurrencies. Now that that's coming in, that's not necessarily bearish, but now we're not seeing the volatility that who've been a crypto trader for the last, let's say, 10 years, the volatility we're accustomed to seeing. And that volatility is good. It cuts both ways, right? We like the volatility when it's going up. We don't like it when it's going down, but we're seeing dampening swings in both directions. And so I don't think that what's happening with Bitcoin in particular is necessarily bearish here, but there is digestion happening. I mean, when we got above 100,000, that was a big psychological level. We got as high as 128, I believe was the high number. Look, there's still a lot of adoption happening here. There's still a lot of people who are finding new ways to get involved in Bitcoin who didn't have access before. People who, maybe are not comfortable opening up a Bitcoin wallet or a crypto or a Coinbase account, things like that. As people get more accustomed to this and as people dollar cost average like I do into Bitcoin, I think Bitcoin eventually resolves higher. But man, right now it's one of those, it's like the Lucy with the football in Peanuts, right? Like Charlie Brown's going in to kick the ball and man, the Bulls just keep pulling the ball away. And it's been frustrating. No doubt it's been frustrating. I've been in and out, stopped out in some positions of Bitcoin over the last few weeks. But I'm optimistic.
Sean, we'll leave it there. Thank you, sir, for your time in those trades.
All right, Josh, thank you.
Now time for some of today's trending tickers. We're looking at Beyond Meat, Bath & Body Works, and Google's Waymo. First up, Barclays is slashing their price target on Beyond Meat in half to $1 a share from $2. The analyst citing continued weakness in plant-based meat demand. And joining me now on this, our very own Brooke Topama. So Brooke, Barclays takes its price target on Beyond Meat. They go to $1. Category demand, they say, remains weak for plant-based meat. The company continues to post losses despite cost control effects. They say this stock is down about 70% this year.
Yeah, and what we're seeing here, think about when the stock went public back in 2019. What we know is that at the time, it ran up as much as $200 per share, really at the height and momentum of the plant-based movement. And then it started getting all these different partners, which I got to cover here at Yahoo Finance. It partnered with McDonald's. It partnered with KFC. At the time that it partnered with KFC, this stock was still at $59 per share. And now, in August 2022, it silently ended its partnership with McDonald's, at least here in the U.S. And now we're just seeing this downward momentum continue. The company is doing everything it can. It expanded into pork, into steak. It even announced on its recent earnings call that it plans to partner with Walmart to increase availability of select products, especially in this environment where they said there is a sustained period of economic stress. So Beyond Meat really just still trying to get in front of the consumer, but the demand just is not what it used to be when the company first went public back in 2019.
Yeah, that stock chart says it all. All right, next, Bath & Body Works getting a downgrade over at Raymond James to market perform from outperform and removing their price target. Analysts concerned about economic pressure on Bath & Body Works' core low to middle income consumers. They say here, Brooke, while we believe there is low-hanging fruit to improve digital capabilities, product and distribution, we expect this will take time to take form, they say, and until then, growth will be below long-term potential, so they move to the sidelines.
Yeah, and keep in mind, this CEO joined the helm of Bath & Body Works back in May earlier this year. He also recently, just in the beginning of November, announced a new chief commercial officer as well as a new chief human resources officer to really try to build up momentum within this company. The analysts here saying that, all these major moves, keep in mind, it's also launched men's, it's launched laundry. A new initiative of Daniel Heath, the new CEO, is also, it's entering college campuses now. It's about at 600. So they're really trying to create this momentum. But right now, as you noted, in this environment where the consumer is not really seeking out ways to spend their money, and they're really keeping to a budget. That's seeing some pressure there. They said that Disney Princesses was a good success in the first half of the year, but Villains and Halloween and some third-party launches maybe didn't perform as well as analysts had hoped for.
All right, lastly, let's check out Alphabet-owned robo-taxi company. That would be Waymo. Will now take passengers on freeways in San Francisco, Phoenix, and Los Angeles. The autonomous vehicles will drive up to the freeway's max speed limit, usually 65 miles per hour. That's going to allow it to sometimes go a few miles over the limit in extraordinary circumstances. This move here, in expansion into commercial freeway service, is being described as a turning point for the company, Brooke.
Are you taking one of these Waymos?
Not yet, but I would. I never have.
Well, there's lots of excitement certainly on the street. You're hearing Tesla back in June. Think about when they did that announcement with their robo-taxi. I believe they did. They tested it in Austin, and that really gave momentum to Tesla that was already underperforming on the year. And there's such excitement on the street about what exactly this could turn into. This potential around robo-taxis. Also keep a lookout on Amazon. We know that they just recently tested Zoox, which is a company that they acquired about 5 years ago for a price tag for $1.3 billion. They finally got that rollout, a test happening in Las Vegas Strip. And so there's lots of momentum around this. And I've seen people jump in one, and I'm always surprised. I haven't driven one myself or gotten in one myself, but the street certainly is excited about the potential of autonomous vehicles and robo-taxis.
For sure. Thank you, Brooke. Appreciate it. Coming up, we catch you down to the closing bell on Wall Street. That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's very own Jared Blickery joining us now with the latest market action. Jared.
Thank you, Josh. We got a split or mixed market today. The Dow, second day in a row that it has notched another record high, up 327 points, or about 2/3%. And you can see it spent most of the day in the upper end of its trading range. Not so for the NASDAQ composite. Kind of a tale of two different markets here. Spent most of the day in the red, closed only down to 1/4%. Nevertheless, we'll look at what happened inside the market with some of the sector action. And then in between, the S&P 500 just barely eked out a gain. That's 6 basis points to the upside. And sometimes I like to track what the S&P 500 equal weight is doing. And that's where each stock gets only one value, or one vote rather. And that tends to closely track the Dow rather than the regular S&P 500. Nevertheless, that was up today by about 1/4%. Taking a look at the bond market, because we reopened today after being closed for Veterans Day. We saw a 5 basis point move to the downside for the 10-year. That's down to 4.07%. 30-year down also 5 basis points to 4.66%. And then the U.S. dollar index, meanwhile, going the opposite way, but only by a small margin there. And checking out the sector action after a nice outperformance by tech yesterday, taking a back seat today. In fourth place, you can see XLK up about 1/3%. XLV, that's healthcare, best performing sector of the quarter, is up 1.41%, followed by financials and industrials. What didn't work, energy, that was down 1.4%, as well as real estate, discretionary, communication services, and staples. If we take a look inside the NASDAQ 100, we can see some red here, some green, so kind of a mixed board. Looks like NVIDIA up another 1/3%. 0.33%. Microsoft, some small gains there. But Tesla and Meta both trading to the downside by more than 2%. Amazon, a little bit less than 2%. And Google down 1.5%. Also Palantir down 3.5%. Checking out the Dow, we have a number of records to talk about, especially in the financial sector. We got JP Morgan, Goldman Sachs, and American Express. All of those closed at records. Goldman Sachs up 3.5%. Also Big Blue, IBM, and let me see, Procter & Gamble. Those are some other records that we saw in the Dow today. So really different look at those different markets, the NASDAQ 100 and the Dow. But here I just want to close with the sector and some of my sentiment leaders here today, as well as laggards. Chip stocks did the best, followed by value, and then transportation, retail stocks, biotech, another day of biotech outperformance. And then to the downside, solar did not do too well. Neither did oil or IPOs or Bitcoin. So actually, I'll leave you off on Bitcoin down 1.25% to 101,554. Josh?
Thank you, Jared. Well, tech stocks have been wobbly the last few weeks as investors oscillate between AI hype and fears that stocks are in bubble territory. Our next guest posits that even if we are in a bubble, it may not be a bad thing. Joining me now is David Wagner, Verdence Capital Advisors Head of Equity and Portfolio Manager. Dave, always great to see you. What is our bigger picture? Because we were talking off camera, and you're bullish.
I'm bullish.
But you're reasonably bullish. What does reasonably bullish mean?
We could go with rationally optimistic
right.
also too if we want to keep throwing out buzzwords right now. But Josh, there's just too much liquidity out there in this market for me to become bearish, to be fully honest. I mean, if you think about the core tenets of this market right now, you have fiscal policy that's starting to work for you. You have monetary policy that's becoming more accommodative, and you just have that CapEx train that just continues to roll down this hill right now, from levels on a CapEx, aggregate amount of almost $400 billion. I mean, just put that in context right there.
It's hard to get your head around it. Yeah.
I mean, that was a bailout package on the fiscal side of things pre-COVID. So there's just too much capital out there sloshing around right now that I cannot become bearish. I mean, I think last week I thought was absolutely comical that, we had a 2.5% pullback in the S&P 500, like 3% in the NASDAQ. And it's like investors just flipped the switch to become more risk averse, or at least more risk off. And I think that's just the huge wrong trade right now.
I have to say, I almost like prerequisite I have to ask guests now. AI boom, AI bubble, where are you there?
Could we have an air pocket? Absolutely. The only bubble that I see out there right now is it's a bubble for people calling for bubbles. and this is gonna sound ludicrous, but I know me, most of my listeners know me, but I think there's good bubbles and there's bad bubbles.
How do you distinguish those two?
All right, let's call productivity. All right, let's distinguish it. Bad bubbles are those that don't have productivity. Good bubbles have productivity. Like if you go back, we're taught in school that all booms, they lead to busts. Okay? I mean, we still talk about the tulip bulb crisis in the Netherlands from the 1630s. I mean, I have two hands. I can't name, 10 different bubbles on my 10 different fingers over the last few hundreds of years. But bubbles that are stemmed out of a commodity base that don't add productivity and they're financed by capital markets, those aren't good bubbles. Think of the housing crisis, stuff that's gone on in Japan. But good bubbles, like the dot-com bubble, a lot of people made a lot of money, a lot of people lost a lot of money. But to me, that was a good bubble. I mean, think of what we had come out of the internet dot-com bubble in its own. I mean, the dot-com bubble happened in 99, 2000. It wasn't until 2004 Facebook was invented, 2006 the iPhone was created, or even Uber wasn't created until 12 years later in 2012. I mean, that in its own created a whole new economy here in the United States, with the gig economy. Think of what Uber brought to us from a jobs perspective there. That added productivity. So yes, we're 99 to 2000 difficult periods of time for the market. Absolutely. But think of the benefits that we had come out of that. And I think the AI boom here could have that exact same ramifications on productivity here in the United States.
Let me ask you, though, one question I hear being asked. I'm interested to get your take on this, Dave. As you see this AI infrastructure build out, I've heard some people say, well, now I'm watching companies tap the debt markets to finance that. And they see that as a yellow caution flag. Meaning, if you're going to fund this with cash, that's one thing. But with debt, that's a warning light. Do you agree with that?
I do. I mean, that was the whole premise of, what Michael Berry was talking about last week with all the off-balance sheet financing and the SPVs. But I actually completely disagree with them. Josh, if you look at the Mag 7 names, I think it's 5 or 6 out of the 7 Mag 7 names, they have net positive cash per share. All right, so they are sitting on more cash than they are debt. And if you take Meta, you take Google, you take Apple, and you aggregate, and Amazon, you aggregate all their EBITDA, it's close to like $800 billion, okay? And in 2030, it's almost supposed to be double that. All right, so literally they have so much room where they could take on debt, where their balance sheets are so healthy, so unencumbered, where I'm not afraid if they have to take on a little bit of debt. But you make the point, you're correct. They funded everything with free cash flow so far, which I love, but if you add some debt into the picture here right now, responsibly, it doesn't worry me whatsoever.
Another issue on your radar here, Supreme Court ruling on the Trump tariffs. You say the bigger impact could be on rates rather than equities. Walk us through that.
Yeah, I think the knee-jerk reaction is going to be a positive for stocks, because if you think about all the capital that could come back into the market to expand margins on the corporate side, I think the long-term ramifications, they're somewhat unknown right now. But if we think about tariffs, I think our minds go straight to, like, man, that's going to create some type of pullback in the equity market. Well, we've kind of seen that trade with Taco and whatnot right now.
He doesn't like Taco, by the way.
He does not like Taco.
He really does not like Taco. If you meet the president, don't say Taco.
No doubt.
No.
But I think the ramifications are going to be on the interest rate side. I mean, at my heart, I'm a head of equities guy. I'm an equities guy. I'm not a bond guy. You'll know that with my personality and everything. But if you pull out all that capital, all that tariff revenue that we've had from the tariffs, obviously, we're going to have to fund a lot of these aspects of the one big beautiful bill from some other aspect. I mean, the ledger is just not going to be reconciled by any point of view. So if you look out down the road, I mean, the amount of U.S. Treasury issuances that we're going to have with or without, the tariffs really being pulled out, it's going to continue to skyrocket right now. And I think that's going to increase the term premium on the overall interest rate, say the 10-year rate, where, fixed income moving forward, it may not be the insulative aspect of a lot of people's portfolios, because rates are just going to be higher for longer.
Dave, always great to see you, especially on set. Thank you, sir.
Hey, thanks, Josh.
Coming up, we get the lowdown on the latest Fed speak, plus the trends to watch for in upcoming earnings calls. That is all next on Market Domination Overtime. Cisco first quarter earnings just now crossing the wire. The stock is moving higher. Let's get you the results. Cisco Q1 adjusted EPS $1. The estimate was 98 cents. And Q1 revenue $14.88 billion to $14.77 billion. So beats there on the bottom and the top. More importantly, let's get to the forecast. What do they see ahead? Q2 adjusted EPS 101 to 103. The estimate was 99 cents. And the Q2 revenue guidance also looks upbeat relative to consensus. They're calling for between $15 billion to $15.2 billion. The street was closer to $14.72 billion. And looking ahead, full year adjusted EPS, they're now calling for between $4.08 to $4.14. They had seen $4 to $4.06. Just looking at comments as well from the CEO here, Chuck Robbins, he is calling out the AI trade here. He says the widespread demand for our technologies highlights the critical role of secure networking and the value of our portfolio as customers move quickly to unlock the potential of AI. And of course, that is a question for Cisco investors, like so many other investors. What will Cisco's role be in that mega AI trade and trend in the years ahead? How much is Cisco going to benefit from that theme? The team at UBS, remember, actually just recently upgraded Cisco to buy, and in part, they told their clients that was because they see Cisco benefiting from that AI infrastructure demand. And I'm just looking here, UBS not alone. About 60% of analysts still say Cisco is a buy here, stock moving higher here in the after hours. Well, I hope rise on the government shutdown coming to an end soon. The White House says the damage has already been done to economic data. Yahoo Finance's Jen Schonberger joins us now with the latest. Jen.
Hey there, Josh. White House Press Secretary Caroline Leavitt suggested this afternoon that we will not receive an October jobs report nor the consumer price index for that month because of the government shutdown.
The Democrat shutdown made it extraordinarily difficult for economists, investors, and policymakers at the Federal Reserve to receive critical government data. The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
The survey period for the October jobs report has come and gone, and the survey period for the November jobs report would have been this week. And given that we're not expected to see the government reopen until later this week, that report is likely to be delayed. But what we could see released in short order is the September jobs report, because that data had already been collected and tabulated. It just hadn't been released because the shutdown had started right when it was supposed to be released. So we will probably get that, albeit that data likely to be stale at this point. I did reach out to the Labor Department to try to understand what the schedule will be for forthcoming data releases. I have yet to have gotten an answer on that. Needless to say, Josh, probably more fog, more cloudiness, pick your adjective, on how we try to assess the economy, the job market, and the inflation as we go through this year. Back to you.
We are hearing, Jen, though, before I let you go, from Fed officials today, right? Nonetheless, what are we hearing from them, Jen?
That's right. We heard from Boston Fed President Susan Collins for the first time since the Federal Reserve met, not last week, the week before. And she says that she supported cutting rates by 25 basis points, but that the bar for cutting rates further is going to be, quote, relatively high, and that it's likely appropriate to hold rates steady for, quote, some time. Collins cautioned that providing more support to the economy through further rate cuts runs the risk of slowing or even possibly stalling, bringing inflation back down to the Fed's 2% target. She wants to make sure that inflation is sustainably coming back to 2% before making any further adjustments. Without a notable deterioration, in her words, in the job market, Collins said she would be hesitant to cut rates further. She noted that the Fed's preferred inflation gauge, which we haven't gotten since August, showed an increase in prices being driven by core goods prices, which can be attributed to tariffs, which she is saying is more than offsetting the decline in housing price inflation. Very interesting, because Fed Governor Stephen Myron has said the exact opposite, that he believes that housing inflation is coming down, continues to think that it will come down, which will bring overall inflation down. He says there's a lag effect there and how we use that to calculate our inflation measures. Meanwhile, Atlanta Fed President Raphael Bostic says it's, quote, an extremely close call between whether the Fed needs to pay attention to the inflation side of their mandate versus the job side, though he believes the bigger risk right now is on the inflation side, because he thinks that the softening that we're seeing in the job market now is more structural. He thinks it's due to immigration. And I will just note that we also heard from Bostic that he plans to step down from the Atlanta Fed when his term is set to expire at the end of next February.
All right, Jen, thank you. Well, corporate confidence is making a comeback, at least in the way executives are talking this earnings season. Mentions of an economic slowdown are at their lowest since 2007, even as companies we know face an uncertain economic landscape. For more, we're bringing in now Scott Krisloff, editor at The Transcript. Scott, it is great to see you. So let's start there, because that data point is interesting, Scott, that you know mentions of economic slowdown at their lowest level since 2007. What do you make of that, Scott? It does seem to track with some of the data points we get, Atlanta Fed GDP tracker, for instance.
Yeah, I mean, I definitely think that CEOs are confident here. And I think the main place that we're seeing that is in capital markets activity. So if you look at any of the investment banks, obviously they're talking about large M&A pipelines. They're talking about IPO pipelines. They're really doing the best business that they've done in a very long time. And so CEOs are confident, ready to invest and spend not only the tech companies on CapEx, but other companies as well.
So when you listened to those conference calls, Scott, and you read the transcripts, were there certain, I'm just curious, sectors where you tended to notice more of that confidence, more of that optimism than others?
Yeah, I mean, I think it's an AI market everywhere. And so I think the tech trade is driving everything. And I think that the tech trade is driving capital markets. So we, break out the financial section. The investment banks are really bullish around all of that. And then the energy section, the industrials, all of it just tied back to the CapEx that's happening in AI. I think outside of that, honestly, you have kind of a middling economy. The consumer is doing fine, spending growth is happening, but the consumer isn't strong, especially low-income consumers. But really, you just have AI driving the entire economy right now.
Beyond AI, Scott, I'm curious, tariffs and trade, how much were those dynamics sort of factoring in and coloring corporate commentary?
That's a great question. You really don't see that much commentary about tariffs and trade today. I think it's just within the industrial sector, there are companies that are exposed to supply chains overseas, but most of them have moved supply chains around so that they're not as exposed to tariffs as they may have been earlier this year. And so you just really don't see tariffs factoring in all that much.
What about the labor market, Scott? We know the Fed focused there, concerned about the cooling they see. Was that a dynamic, a trend to watch in the calls?
Honestly, the sentiment around the labor markets is probably weaker than the reality around the labor markets, at least from what we're seeing in the calls. I think most of the quotes that we pick up from calls around labor markets still suggest that labor markets are strong and tight. Certainly, consumer spending seems to be leveraging the low unemployment rate. And overall, people are reasonably confident about their jobs, even though there's weak sentiment, especially driven by maybe AI taking people's jobs.
What about the government shutdown in focus too, Scott? We got a vote coming up here in a few hours. Was that coming up on calls? Did CEOs and CFOs bring that up as a potential impact on consumer demand, for example, or operations?
Yeah, Josh, it's really incredible. It's just like a rose-tinted economy all over the place. And even though people do pay lip service to the government shutdown and potentially impacting the economy generally, you're really not seeing a major impact of it. And it's really just lip service. It's just that.
About deal making, Scott, you were there when Trump was moving back into the White House. It was thought, okay, here comes a rush of deal making, a rush of M&A. Was that a theme?
Yeah, absolutely. So you're seeing a lot of capital markets activity, but I mean, kind of to this point, you're seeing pipelines that people are still talking about, like robust pipelines in capital markets activity. But you have seen more IPO activity, obviously, and you have seen deals announced. But in general, the CEOs of the big banks are extremely bullish on their own capital markets businesses. As
you made your way through these earnings calls, Scott, I'm just curious, the takeaways for you in terms of what perhaps is suggested to you about where we are in the business cycle as we head into 2026.
Look, that's a great question. The business cycle is the question itself around. You've got a traditional business cycle that's happening with interest rates, but layered on top of it is what I spoke about earlier. It's just this AI trend and trade that is overwhelming pretty much everything else in the economy. Because capital markets are so leveraged to the AI trade, because the Mag 7 represents so much of the S&P 500 today, and there are so many capital markets players that are benefiting from the AI trade, basically. So the economic cycle, honestly, the traditional one, the industrial inventory cycle, the consumer cycle, those traditional pillars of the economic cycle just don't matter to capital markets as much as they traditionally would.
Scott, always great to see you and have you on the show. Thank you.
Thanks, Josh.
All right, time now for To Watch, Thursday, November 13th. We're nearing a big day here at Yahoo Finance, our annual Invest event. It's all starting at 8 a.m. Eastern from our New York City studios. We've got a special full day of live global coverage of the key themes driving this market, AI, crypto, and a whole lot more with the top people in corporate America you'll want to hear from. Questions for our esteemed guests are now open and flown in on the Yahoo Finance community channel right at the top of our homepage, so keep them coming. Moving over to earnings, the season rolls on with some key reports on Thursday. We got Disney, Applied Materials, and StubHub. Disney announced results for the fourth quarter before the markets open. Analysts expecting a solid Q4 for the company, driven by strong performance in its parks business, despite competition from Comcast's new Epic Universe theme park. Taking a look over at the Federal Reserve, too, we're going to be getting another round of Fed commentary on Thursday from multiple Fed presidents, including Atlanta's Raphael Bostic. Bostic saying in a statement on Wednesday that he will be leaving his position when his term expires in February 2026. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 8 a.m. Eastern for Yahoo Finance's live Invest event. You don't want to miss it.